All right, so now it's time that we're going to actually fill in the answers here. I'll walk you through all of the steps to do that. We'll do that here on this page. And as we go through each example, I'll show you on the calculator what the steps are to figure out the answers here. So in example number one, we have a loan amount of 100,000, a term of 30 years, and an interest rate of 7%. And if you remember, I had said that there was nothing else that we had to do in this example. So all we're doing is solving for what's highlighted in the yellow, which is the principal and interest portion of the payment. And the way we do that is we would take 100,000, and you always put your money in first. Just make sure first we turn on our calculator. And I always use this step where I go Shift X and then clear out everything. This way, if anything was in my calculator stored from a previous uh, transaction that I might have done, I know that I'm starting from square one. Everything is cleared out. So here we have 100,000. So we do 100, and I use the 000. Again, doesn't matter whether you use it or not. We're going to store that in the button that says the loan amount, and it tells you right there it's 100,000, and that is the loan amount. Then we have a term of 30 years. 30 years is the most common length for mortgages, but you can have a mortgage term of any length. There are companies that will, do 27 and 26 and 25 when they're refinancing you. But usually on the purchase of a home, it's, I'm going to say probably 99% of mortgages that I see done are 30 years. And we do get some people that do a 15-year. We'll talk about it later about the, whether to do a 15 or a 30, what's in your benefit. But for right now, a 30-year term is what we're using for this example. So we'll do a 30-year term. And if you remember, this says 30 annual. So if you toggle through again, it'll tell you 360 months, which is how many months there are in 30 years. The last piece of the puzzle is the interest rate, which is 7. And you don't have to hit 7%. You just hit 7 and put it in the interest rate, and it tells you right away it's 7% interest. And we're going to solve for the payment. This is what I like about the calculator. All you do is just put in the amount that you want, store it directly in the button that you need to, and then you hit the button that you're looking for the answer, and it tells you 665.30. So 665.30 should be the answer that you came up with for that first example. That's the one that I showed you earlier on. Some people, when I'm training this class, whether it's well, usually when it's live, I'll hear people say to me, "Hey, Doug, that's the example we did earlier," and that, yes, they were paying attention to that. That's all good. Now the second example that we have here, uh, same thing. I'm looking for the principal and interest, and if you look all the way across, there is nothing else that has to be done on this. So I want to start out very simple. All right, we have a couple of different things. We have a different loan amount, of course. We have a different term and a different interest rate. So what we're going to do now is we're going to do the shift X or shift multiplication, whatever you want to call it. We clear everything out, and you should be ahead of me already knowing that it's 247,000. Don't forget the 500. Sometimes people forget to put that in, and it'll change your calculation by a little bit, but you want to make sure you're as accurate as possible. Again, there's your 247,500 loan amount. Now we're going to do a 20-year term, which means that payments would be higher than if they were a 30-year term. And we're going to do an 8.125. Now, in the mortgage lending business, usually things are done by eighths or quarters. A lot of times quarters come into play, but you can go down to eighths. Below that, it's usually not in the mortgage business that we see rates, uh, that would be less than, an eighth. So an eighth is usually where you're at. All right, anyway, we have all three pieces of information. Remember, I said you need to have three pieces of information before you can solve for the fourth. In this particular case, we have $2,089.48. So $2,089.48 would be the payment that we would have on a 20-year term. Now look, if you just wanted to change it to say a 30-year term, you just hit the 30, you change the term, everything else is saved in the calculation, and you'll see that the payment will be a little bit less, $1,837. So that'll give you an idea of how to handle that. Now let's go to the next one. Here we're looking for a PITI payment, which is principal, interest, taxes, and insurance, of course PMI or homeowners association dues, anything else that might be added in there. So we'll know automatically that something has to be additional here. And I throw a little curveball here. Here I give you what the payment is. We already know what the payment is, what the term is, and what the interest rate is. We're going to solve for the loan amount first. So we clear everything out of our calculator. We put in $2,450 for our payment. Put in a 30 term. Then we put in 11 as an interest rate. And a lot of you might be saying, 11 interest rate, whoever would ever pay that? Well, back in the late 80s, interest rates were as high as 18.5%. So if you're just getting into the mortgage business, or you've only been in the mortgage business for 10 years or so, you may not have known that interest rates were so high because they've been so low for such a long time. But trust me, interest rates change all the time, and they can go very high. So here we have a loan amount of $257,265.55. All right, now we want to figure out, knowing this, what is the PMI that would be paid. And the rate of the PMI, I just made it up, is at 1.01%. It could be at 0.8%. PMI on conventional loans goes based off of the risk level, and the lower somebody's credit score is, the higher monthly PMI they'll pay, and the less money they put down, the higher their loan to value, also is a risk factor. So if somebody has a fairly low credit score and is not putting down a lot of money, they're going to pay the highest rate. With mortgage insurance premium on FHA loans, every borrower pays the same amount, the same rate. But in this particular case, I just made it up. It's 1.01%. And here's where mortgage insurance goes. Remember this insurance button here? To get to it, we have to put it in the mortgage insurance key, which means that we have to hit shift before we do it. So we're going to do 1.01. We're going to shift. I'm going to store that as mortgage insurance, and see, it'll tell you that it's mortgage insurance right there, annual mortgage insurance. And if you want to know how much that actually came to per month or something like that, you can toggle through. So first you'll get the annual, that's $25.98 for the year. The monthly would be $216. So if we have a payment here of $24.50 of the principal and interest only, another $216 would bring us to 26 and change. So here we go to the button for payment. $24.50 is our P&I, as it tells us right here. We toggle through again, $2,666.53, and we can store that right in here, $2,666.53. And I am now going to shift X and clear out my calculator. We're going to go on to answer number 4. Now, if you were able to get that answer for that one, you're doing very, very well. If you're not, please don't feel super frustrated, doing this stuff for the first time, especially if you're not a math person. There are a lot of people that get into this business that did not really do well in math in high school or college, and a lot of these concepts are almost seems like the first time you're ever seeing them or hearing them. And in some cases, even if you were good at math, these are things that you're seeing for the first time. and it takes a while to kind of understand how it all works together. I mean, look, the 1.01% really is like this. All right, let's go back to that example. So 257,265 and 55 times 1.01% equals, that's the 2598 that we came up with before. And then if I divide that by 12, because there's 12 months, we'll come up, I think it was $216 or something like that, right? 216.53. So all the calculator is doing those calculations for you by putting it in the mortgage insurance spot. So you don't have to physically go out and separately calculate this and save it or write it down somewhere. It stores everything for you. It does all the calculations for you. Again, that's why I love this calculator. It's really, it makes it really, simple for people like me. I call it the KISS method. Keep it simple, and a lot of people say stupid, keep it simple, son, whatever you want to call it. But for me, I just love using this because it does make it really that simple. All right, so here we have another example where we have the loan amount, the principal and interest amount, the term. We're looking for the interest rate that would be on this type of a loan. And there is nothing else that's on here. So if you knew what somebody was paying in just principal and interest, remember, it can't be the PITI payment that you're using. But if you knew what term they originally took it out, not what's left on their mortgage, and what their original loan amount was, and they're not sure what interest rate they're paying, you could figure it out this way. So again, even though it says 0 on my calculator, I'm going to do Shift X, clear it out. Just a habit to get into. And then we're going to do 475,000 as my loan amount. We're going to do $6,375 as my payment. And then I'm going to do 25 as my term. And then we'll come up, it'll solve for an interest, 15.79. So 15.79 would be the interest rate that borrower would be paying on that particular loan. Now, if it seems high, again, interest rates went as high as 18.5% back in the 80s, so it's not that far out of the realm of possibility. All right, number 5. Number 5 is kind of a tough one. I can't see you guys, obviously, but you'll know, and you can say whether or not you struggled with getting the answers for this particular example. Now, some of you may have come up with answers in here in the P&I and the interest, and then you came up with a PITI and a total. I will tell you that if you did come up with answers, no matter what your answer was, it's completely wrong and inaccurate. And the reason is, if you look at these 4 things, these 4 variables, I had explained earlier that the only way that you can solve for any one of these variables is to know exactly what's in 3 out of the 4. So you can know the loan amount, the term, and the interest, you'll solve for the payment. You could know the payment, the term, and the interest and solve for the loan amount. You could know the loan amount, the P&I, and the term, and solve for the interest, which I showed you. But if you only have 2 of these, if you're missing 2 variables, there's no way to answer it. And I did not give you a P&I or an interest on that. So the answer is that you would not be able to figure these things out. So let's say that we went ahead and we gave this a interest rate of, say, 7%. All right, I'm just making it up for this example now. We're going to go ahead and put in, first we're going to Shift X again. By the way, the one thing that I have not been doing on these examples with you, but I highly recommend that you do, is that once you get your answer, you Shift X and you start all over again. you should always do your answers twice. You should always cancel it out and do it twice because we will make mistakes. It's not a matter of if you'll ever make a mistake. It's just a matter of when you will make a mistake. And trust me, once something leaves your mouth and your customer or client hears what you said, they're going to stick to that. They're going to go, oh, you told me this. So just try to take your time and recheck yourself. There's nothing wrong with that. That's a very prudent thing to do, and it shows that you know you're taking caution. So let's do this example here. We cleared everything out. We have a $350,000 loan amount. We have a 30-year term, and we have a 7% interest rate. So the payment there would be 23, 28, excuse me, 56. Now, of course, if you're talking to a borrower or something like that on the phone, you tell them it's around 23 and a quarter, 23.50, somewhere in that range. You're not going to give them to the penny because closing costs change, things change, and you're going to be off by a few dollars. I'm a big believer in under promising and over delivering. So I would tell them, your payment's going to be, somewhere around 23.50 in that range. Give or take a few dollars either way. This way, if I come in less, I'm a hero. If I come in a little bit more, I'm already covered because I went up to 23.50. But of course, you use the selling style that you like and what works best for you. Take advice from your manager or the owner that's been doing it for a while if you're new. And if you've been in the business for a while and you understand that concept and you're doing well, listen, you don't need advice from me on that. Keep doing what you're doing. All right, so now we're going to look to see what a PITI payment would be. Well, can you tell me without me figuring this out if I have no taxes in there, no insurance, no PMI, no expenses, what do you believe that the PITI payment would be? Well, it would be exactly the same, right? So let's go through this. Right now we see it's a P&I of 23.28. Remember, if we toggle through the button, it'll now tell us what our PITI is. Well, there's nothing that got added on in there. So we would have the same 23, 28, and 56 cents. And the total, like I said, on this calculator would be if there was a expenses like homeowners association dues. Again, because there's nothing added in there, when we toggle through it, it'll tell us the total payment. That means everything. And of course, that payment right there would be the same 23, 28, and 56 cents. All right, let's do this. Before we move on to the next answer, we'll go back to the total. Oh, the interest only would be on there. I don't have that on my example, but if somebody was paying interest only, $2,041 would be their interest only payment. So we got P&I of 23.28. Again, this was a 30-year loan at 7% interest. Let's just do a couple of things here that are not on the spreadsheet, but let's do it with this particular example. So let's say that you wanted to, a borrower said to you, hey, listen, I make a lot of money and, I'm not sure whether to do a 15-year deal or a 30-year deal. Let's say they could afford the payment on the 15-year deal, they would be qualified. There's a couple of things that you could do, and you can advise them, and help them out. Now, one of the things is, obviously with a 15-year payment, the payment's going to be a lot higher, but the total interest that they'll be paying on the loan would be a lot less. Now, a lot of loan officers, and I'm not saying that I totally agree or disagree. It depends on each customer, but I have used this before myself. A lot of times I'll tell people, instead of locking yourself into that 15-year deal, you should do the 30-year deal and then do biweekly payments where you pay half your payment every 2 weeks. You get an extra payment in there. You'll actually get more than an extra payment because if you're paying a PITI payment, let's say your PITI payment is $3,000 a month, and I'm just making it up, but $1,500 of that is for your taxes and insurance. Well, if you make an extra payment for the year, because you're paying every 2 weeks, you're making those extra half payments, you're actually paying some of your taxes and insurance, which is already fully funded by making those payments. The extra payment then, that tax insurance, is actually going towards principal reduction. So you're gonna cut down your loan sometimes to, as little as 23, 24, 25 years, based on that. And I'll show you how that works. So that gives the borrower flexibility. So if they don't have the money, the extra money to pay, they don't have to pay it. But if they're locked into a 15-year, they have to do it. But again, this is a conversation that you'll have with your borrower. So right now we're at the 30-year term, right? So let's look at the amortization. The total amortization on this particular deal for the 360 months is 490,000. We'll call, all right, so let's say 488. That's the 30-year payment, right? Without changing anything. Now, 15-year deal will give you a lower interest rate. I'm not going to go ahead and change the interest rate. I'm going to keep the interest rate the same. The interest rate on a 15-year might be 6.5%. But let's just see what the difference is if we do it here with the same interest rate. All right, so 15-year term. We're going to go to the amortization on that. And it's only 216,000. So 216,000, they're saving themselves 270,000 basically. So that's a lot of cash to save. Now, if they know that they're not going to be refinancing, they know that they're not going to be doing anything other than paying off their loan, you can see that their payment now is going to be $31.54. That's what, $800 more every month. Well, if they have that money to do that, the cash flow is pretty steady and everything like that, fair enough. But you as a loan officer now have this right at your fingertips on this calculator. You don't have to go work it out. You could tell them exactly what it is right from day one. As a matter of fact, let's say they were able to get a 6.5 interest rate because it's a 15-year term. What happens is the payment is $3,000, so it's a little over $700 more. Let's see what the amortization is on that. It's only $198,000. So you're talking a couple $100,000. You're talking what, 300,000 almost, just about 300,000 in savings. But they would get a similar savings if they paid that higher payment. Now let's see. The payment there we said would be $3,048. $3,048. Let's say they didn't do it in a bi-weekly, but they made that payment and we made the term 30 years, right? And the payment is going to be, we have to put the payment in as the 3,000, I forget what it was. It's not going to show up now because I changed the term. But it was 3,000, let's call it $3,030. I forget, I didn't write down a number, but I forget exactly what it was. If you make that higher payment, the term would be 15 years, a little over 15 years. The interest rate, though, let's do it at the 7% interest rate. All right, the term would be 16 years. So if they made that extra that payment as if they were paying a 15 years on the 30-year loan, they would pay it off in a little over 15 years. So you can play around with all of these numbers. This is not something that comes up very often with most borrowers. Most borrowers is pretty straightforward, but it's not a bad thing to know a little bit extra on this. By the way, where these kind of things come into play that people are really impressed is if you're dealing with a certified financial planner or a CPA. Certified financial planners and CPAs are extremely smart people. They know a lot about finance, but they don't know everything about mortgages, reverse mortgages. They don't know a lot of these things. But I will tell you that you can talk to them in 10 minutes, what would take hours sometimes to speak to a average customer, because they understand numbers. They understand the time value of money. They understand, hey, if I do this, what's the benefit over here? They may know that their borrower is in a better position, their client rather, is in a better position by going into the 15-year deal because of tax consequences or something like that. That's not something that we as loan officers give advice. We're not tax professionals. We're not certified financial planners. But if you're talking to one, a lot of loan officers are nervous about talking to them. I used to love talking to them because they're pretty much, they understand exactly what's going on and they will help make a decision. And by the way, whatever decision they make for their client is the loan that you would go for. And with a certified financial planner or CPA, you might give them a couple of options where one is maybe an adjustable and one is a fixed, or maybe one is an FHA and one is a conventional. Whereas with the average borrower, you're not giving them those options. It's rare. Usually you'll just give them what's in their best interest. But if they do get, if you do offer them any kind of options, never make it more than two options, this one or this one. Because once you go to three or more, and I've seen loan officers over the year do this, uh, you will give your customer paralysis of analysis and they will shut down. They will have to think about this. It's way, way too much information. You are the professional. They're coming to you for advice, and make it as simple as possible for them. But again, if you're working with a CPA or a certified financial planner or anybody that has a financial background, look, I've had customers that were not certified financial planners or CPAs or working with one, but maybe they were an engineer or an architect, or they there's a lot of smart people out there. Everybody you deal with is not going to be like, oh, tell me what to do. Okay, no, you'll be on the phone with some people that are pretty smart. They're going to ask you some really great questions. And if you're not armed or equipped with knowing how to get to those answers that they're looking for, like the amortization in the first 7 years, and explaining to them why these things are that, or why you're giving them a higher interest rate and you're giving them a lender credit at closing. If you can't work those things out, you're at a disadvantage. It doesn't mean that you won't be doing loans, but my theory is this: if you're someone that closes one loan every month, and you're making $3,000-4,000 a month and you're getting by, well, imagine if you step that up to closing 1.5 loans every month. That's only another 6 loans a year. But imagine if you went to 2 loans, you doubled your income. And if you're closing 3 loans a month, you're making some nice money. But what if you started closing 4 loans a month because of the knowledge and information that you have? You become a trusted advisor. You're much better at talking to real estate agents and to the consumer about what you can do for them. And don't don't make the mistake of getting diarrhea of the mouth and trying to show everybody how much you know. Personally, if I have somebody that comes to me, I've given them their disclosures and they're good with everything and they understand it, and it only took an hour to do all of that stuff, great, sign on the dotted line, let's go. If somebody needs 4 hours of work on their loan, you give them the 4 hours. But don't take somebody that says, okay, I understand everything that's going on. This is my payment. This is my interest rate. We got to make our first payment on this and this date. I'm good with everything. Let's go. Uh, don't start showing them and trying to dazzle them with your brilliance. By the way, did you know I knew how to do this? And this is what's going to happen. You, you're going to wind up talking yourself out of a deal. You're going to confuse the borrower. So do yourself a favor. Just give the information that's necessary to make the deal without shorting them on the information. What you don't want to do is you don't want to leave stuff out. That would be a violation of a lot of rules and regulations, laws. It's not ethical. You want to make sure that you have an informed consumer in front of you, and if you're equipped with all of this knowledge, you don't have to give them all the knowledge. When you go to your doctor doesn't tell you, if you come in there with you need medication for a cold or a flu or something like that, they're not going to tell you about the 9 million other things that they know. They're going to talk about that particular problem that you have at hand. So do yourself a favor, take my advice, and don't get uh, into uncharted territory if you don't need to. All right, so let's go on to number 6. Number 6 here, now we have a little bit more challenging. We have the loan amount. We're solving for the P&I, and we're also going to solve for the PITI payment. The reason why I don't have a total in there is because, think for a second, what type of property are we not buying here? If you said condo or co-op or a townhouse or any kind of a community property that would have homeowners association or anything like that. So you can see I have nothing under expenses. All right. I really should put that title as expenses, HOA, or CAM fees. But because the calculator says it as expenses, that's why I do it the same there. But we don't need to figure out a total. But you do see there's taxes in there for the year, right? And you do see taxes are in there for also. And we also have a PMI. So what we're going to do is we're going to start by doing Shift X, clear out everything that we had in there, and we'll put in the $650,250 into the loan amount. We're going to do a 25-year term. And look at this. This confuses a lot of people. 7 1/8. Oh my goodness, what do I do here? How much is that? There's people that put in 7.25, whatever. Some people get it, what it is. Look, 1/8, it's a fraction. If you don't know what it adds up to, let's do this. Let's do Shift X for a second, and I'll show you how the calculation goes. It's 1 divided by 8 equals. Now let me show you something cool on this calculator. It comes up with 0.13. That is a wrong answer. The reason is because the decimal place is only set to 2 decimal places. On this calculator, I can go Shift 4, and to bring it out to 4 decimal places. That's a 7.125 interest rate. It's the same as the 0.125 that we have up here. I just wrote it as 7 1/8 to throw you guys off. And a lot of people get confused by that. I wanted to unconfuse you. By the way, by going back to Shift X, it automatically brings it back to 2 decimal places. Let's say you wanted to do all your calculations in 4 spots. You could just go Shift 4, and it'll automatically do everything in 4 spots. I don't do them in 4 decimal places because I know that I can change it if I need to, and you should change it. All right, let's go back to putting in the loan amount. We got $650,250, and I do realize that my program here is purchased all over the United States, and there are areas of the country where a 650,000 is a gigantic house. The average loan size might be 125,000, 150,000. Here in the New York area, we do a lot of average homes that are $300,000 loans, but we have a lot of properties that are multi-million-dollar properties. So that's why I mix them up from a $100,000 loan amount to 650,000. Of course, these are the kind of loans that you like to work on because we work on percentages. It's all good. All right, let's go to 25 years as the term. And then, of course, we now know that 7 1/8 is 7.125. Put that in the interest rate, and we'll solve for the payment. The payment here in this case is $4,647.81. Just for the example here, we use the pennies and everything like that, but normally you're not going to talk to your client or your customer about the pennies. You would say $46.50 will be your payment or something like that. All right, so now we have a PITI payment that we want to work on. So we have to put in the taxes, insurance, and the PMI. So I want you to pay close attention to this. Rewind the video and play this over again as many times as you need to, because I'm going to show you something pretty cool on the calculator. I showed it to you before. I don't expect that you remember what the procedure is here. Even if you read the book and you practice, chances are you're not going to remember this until you actually see it done several times. So we got $7,580 for taxes for the year. So $7,580. That's going to go in the tax button right here, right? Remember, I said that was for the year. Again, you toggle through, it'll tell you what it is for the month, right? And you can actually toggle through again. It'll tell you what the percentage of your mortgage balance, but we never talk to the customers or clients about that. It's in there, great, but you don't have to ever tell your customers about that. It's not something that comes up usually. Now, the next thing is we have insurance. But if you notice, the insurance here is at $150 a month. Well, how do we get it into the insurance button, not mortgage insurance, but the insurance button as a monthly amount. Well, we do this. We do 150, right? And then I'm going to go shift, but I'm not going to go directly to that button because I would put that in the mortgage insurance. I'm going to go to the backspace where it changes it over to $150 per month. You see it says right there above there, periodic. That means monthly. All right. Now, if I put it into the insurance, it's $150 per month. Well, that would be what, $1,800 a year? If we click the insurance button through, toggle through, there it is, it's $1,800 a year. When it does my whole PITI calculation, it's going to use it as 150, and it's going to use the taxes as whatever the amount was there, $631. So it will automatically calculate those. Now I have PMI, or mortgage insurance premium, at 0.85%. So that's right in the insurance button also, but it's mortgage insurance. Here's how that goes. It goes 0.85, and I go shift, and I'm going to go right to the insurance button this time because it's going to put it in as mortgage insurance. Now it tells me that's the annual rate. If I click on it one more time, it'll tell me this borrower would be paying $5,500 a year. If I click it again, it will tell me it's $460 a month. So that looks to me like we added about $900 onto our payment. So we should be around the $5,500 payment, right? So if we hit the first payment, we're going to come up with the P&I only, right? 4647. And if I did it in my head correctly, it'll be about 5,800. So 630, 150, and whatever the amount was for the PMI was 460. Okay, so 460. So all of that together adds up to a PITI payment now of $5,890.07. And by the way, do you see why I calculate everything and I check everything out? Because I just did that quickly in my head and I was off by a few $100s. And I do numbers all the time. And so if I'm making an error like that, if I was talking to a customer or something, I say, oh yeah, I think it's going to be about 5,500, and I was actually closer to 5,900, you can imagine the names that they're going to call me, what they're going to do. And if I tried to calculate it on $5,500, they might be qualified under debt to income ratio for their loan. And at 5,900 or 5,890, they're not qualified. And I told somebody they're approved for a deal that they're really not. So that's a big mistake. So you want to make sure that you do this. And by the way, when you're doing a complicated calculations like this is where you write down your answers, clear everything out, go back and do them again. Now, I'm not going to do them again here. I'm fairly confident that I got them right, but maybe I got them wrong. I don't know. You'll be able to do it a couple of times and check it out. And that's part of the homework that I'd like you to do. Go back and verify everything, make sure everything is good. All right, let's go to number 7. We have P&I again that we're going to work on, which is the most common thing that you're going to be solving for. But we also have a PITI payment. Again, no total payment here. So we have the interest rate at 6 3/4%. How do we figure out what 3/4 equals to? Well, if you don't know that it's 0.750, again, you're going to go 3 divided by 4 equals 0.75. So you know that the interest rate here would have to be 6.75. So let's start with 425 000 button 1,000. We're going to do a 30-year term. We're going to do 6.75 as the interest rate. And we solve for the P&I, which is $2,756.54. I would hope by now that this whole process is becoming easier for you. And repetition is probably the most important thing. That's why I do so many examples. That's why I take my time with doing this because it does matter. All right, so we're going to look at uh, the rest of this example here. We have $480 a month for the taxes. And remember, if we're going to do monthly on this calculator, we're going to put the 480 in. But remember, it's $480 a month for taxes. So if we just went right to the tax button, it would only put it in as $480 a year because these are preset to be annual. So we're going to go shift. We're going to change it to a monthly, which is $480 per month. All right, and if you wanted to see how much that was annually, you would be able to toggle through and see it's $57.60. The next one we have is the insurance at $750 a year. Since that's an annual amount, we don't have to do anything except put it right into the insurance button. And again, toggle through. It's $62.50 a month. You could leave it on the monthly. You could leave it on the annual. It's not going to change anything in your calculator. All right, so in this example, we don't have any PMI and we don't have any expenses. So we can solve for both the P&I, which is $27.56. It'll bring us right back there. And the PITI, which is now $32.99. $32.99.04. And remember, the reason why we need to figure that out is because that's the amount that we'll be using in a debt to income ratio for a borrower. We have to use their total PITI payment for the what they call the front ratio or the housing ratio. It means the same thing. Again, we'll go into that later in the DTI area. So here we're going to solve in the last one. We're going to solve for the payment. We're going to solve for insurance. I don't know why I put that one in there, but it is in there. We don't have an insurance to solve for unless we knew that there was a rate. So we'll make one up for this example. Over the years, I've never changed that. And every time I come to it, I go, oh, I need to change that. And I never do. But it actually is there. I think I originally put that in there to kind of trick people into what's, oh, I actually know why I did it on this one. I haven't done this one in a while. It's because this one here is a co-op or a condo, and the insurance is going to be paid in the expenses. Now, remember, the common area maintenance or homeowners association dues, it might only be $100 out of the $600 that goes for insurance, but we leave this blank. The reason why we leave it blank is because we're not going to double charge them for it. It's within their $600 a month. So we'll figure out for the PITI payment and the total payment. Let's start out with the $750,000 on the loan amount. And we'll do the 20-year as a term. And then we'll do 8.375 as the interest rate. We'll solve for the payment. And we come up with $6,449.46. Now, how do we figure for the PITI payment? Well, we have to put in what the taxes are, $865 a month. Again, $865 and a monthly amount going into the taxes would automatically make it a yearly amount. So we're going to change it into a monthly amount. We're going to backspace there and change it into a periodic. $865 a month. And then we have $600 a month down here. That's an expense. That's the homeowners association dues. So we go ahead and we'll put that in the expense button. And if we hit the payment once, we come up with $64.49. And when we hit it a second time, we're going to come up with their PITI payment. Now, in this business, if I was going to say PITI, I really mean total. But remember, this calculator will give you both. Again, I wish that would go away, but we really need to know what the total payment is here. So we hit it one more time, and you can see it's $600 a month higher, as it should be, because we added in a $600 expense that's on there, homeowners association. So really, I would call this the PITI, and everybody else in the business would call this the PITI payment. Although You want to make sure if you say total payment, you're very clear about what you're saying. And if you're showing something on the calculator, you want to make sure that you're very clear that there's a difference between, the PITI payment and the total payment, especially on condos, co-ops, townhouses, those kind of things. So I hope this section has been very helpful for you. I know it has been over the years. That's why I've probably been using this spreadsheet for 15 years. A lot of times I don't make it all the way down to the eighth one if I'm doing a live class. We might only go down to the fourth or fifth one, and everybody feels like they have everything they need to do, and I let them carry on. But here I wanted to give you the full version of what goes on, and so now you have it. You should go back over it. I thought I had the answer key listed, but I don't believe that I do. But you do have the answers now. Just check them, and let's move on to the next chapter.